Good afternoon, everyone, and thanks for joining us on our regular Thursday afternoon Innovative Business Advisors webinar. I'd like to share with you a little bit about what we're doing today. So as far as panelists go, it's myself, Marquita Wiley, and Steve Denny today. And we will actually have a little bit of a different format today. For most of the discussion today, Steve and I will be discussing together some of the, I want to call them non-financial or softer attributes to building value in your business. So that will be the discussion today. And I think you'll find this discussion very, very interesting. But before we get into that, Steve will give a very, very, very brief update on federal regulation related to the CARES Act and COVID relief in general. Not a lot happening, so Steve will give an update on that, and then we'll jump into the webinar. So with that, Steve, do you want to give a quick update, and then we'll pick up on the discussion on building value in your business?
Absolutely. So we were honored and pleased to be able to participate on a conference call yesterday with senior representatives from Capitol Hill, and we got a little bit of an overview of what's going on. And so I just thought I'd share that with our audience. So as everybody's aware, there is the House bill, the Senate bill, and then the White House's position, which is being managed by Secretary Mnuchin from the Treasury. So there is still quite a bit of discussion going on, even though the Speaker of the House apparently threw down the gauntlet the other day and said that there was some artificial deadline imposed. But according to all that were on the call yesterday, those discussions continue, and apparently they appear to be relatively close. So there is some hope that that a deal may happen before the election. That was interesting news. The most interesting news is, again, as you've heard us say many times on previous webinars, there is significant consensus around blanket forgiveness happening for the PPP borrowers that had loan amounts of $150,000 or less. So those provisions are still prevailing in all of the legislation that is out there. As you may have seen through our update last week, Treasury has issued basically a very streamlined forgiveness process for those that receive loans of $50,000 or less. And obviously the legislators' hope is that that will be extended up to a total of $150,000. The significant new piece of information that we'd like to share is there also appears to be a broad consensus on Capitol Hill for a second round of PPP loan availability. And that would be a little bit different. What seems to be coming together is that second round of PPP eligibility may revolve around whether or not your business has experienced a revenue loss. And currently the thinking process is somewhere around a threshold of 35% or more. So if your business has experienced a revenue loss of approximately 35% or more, there may well be a second round of forgivable loans that are going to be coming available. So that was news to me particularly, and the fact that that is being seriously bantered about, we thought we'd share that with our community here. If you're connected with any legislators or have their email addresses or what have you, and you've heard it from us, don't be afraid to send them a note and just say, hey, I want you to know, I would either be in favor of or opposed to these things that we're hearing may be active out on Capitol Hill. So they need to hear from us. And I think that's the big thing. Give you just a little bit of insight. There appear to be two major stumbling blocks in the negotiations between this fourth round. And those stumbling blocks revolve around the amount of supplemental unemployment compensation that would be available to those that have been affected by this. So generally, as a general rule of thumb, the Democrat side wants to maintain a federal assistance of $600 a week plus whatever the state benefits are. The Republican position is they'd like it to be somewhat less, potentially down to $300 a week supplement. So both sides appear to agree that there should be some supplementation, but what level of supplementation is where the disagreement tends to be. The second key point of disagreement between Democrats and Republicans right now appears to be around liability. So there have been, according to the Federal Register, there have been in excess of 5,000 cases that have been filed, under the pretext of COVID, blaming COVID for some fault on either an employee, an employer, or a supplier, et cetera. And our congressional leaders have disagreement about should there be some liability protection for various companies in that regard. So that's the other major point of disagreement. So, again, it's a great time to be a citizen and to make sure that our voices are heard. So we would strongly encourage you to reach out to your legislators and let them know your concerns and ask them to get moving, and let's get some help out there. So with that, Marquita, hopefully that'll provide a little bit of update as to what's happening, and we can move into the breadth of the program here.
To the discussion. Okay, great. Steve, thanks so much for that update. So what I'd like to do is preface this a little bit with exactly what we're talking about in this conversation that Steve and I will have today. And we're talking about soft contributors, if you will, or softer drivers to the value of your business. And what I mean by that is, for any of you who may have had a business valuation done at this point, it would be awesome if Terry were on with us, because Terry is our certified valuation analyst in the group. People who carry that designation go through substantial training and use fairly sophisticated models to determine the value of the business. And typically that determination is very heavily weighted on the financial profitability of the business. So they look at financials, they look at tax returns, they look at a lot of financial indicators and make a determination based on profitability. And we often hear people talk about multiples of terms like EBITDA and owner discretionary, which are indicators of profitability normalized for a business. What we are talking about today is what a buyer will look to that may cause them to take a look at a business, two particular businesses that actually are in the same industry, that have exactly the same owner discretionary earnings, the same profit, the same EBITDA, and why a buyer may offer more for one business than the other. And those are more judgmental factors. We call them soft factors as to why a buyer will spend more or pay more for that business. So with that said, we're going to go in and talk about the 8 drivers. Okay. So let's go forward and just name them first, and then we'll drill down in a couple later charts and talk about the detail of what they are and discuss scenarios where we've seen these particular drivers have a specific impact. One of the things that we do, and I'm going to have a little bit of a commercial for us on the front end and a little bit of a commercial on the back end, because one of the things that we do is we will offer all of our clients an assessment, a baseline assessment opposite these drivers that help you to understand those non-financial drivers and how well you stack up relative to your industry. So on this chart, what you'll see is there's an industry average for a specific industry, and there is your score. This is a mock-up. It's not anyone's score in particular, and it's not any industry in particular. It's sort of an average of all averages, but it's a basis for us to explain to you or name the drivers. And the first one is financial performance. And it's not necessarily financial performance as you know it relative to baseline profit, but there's some other indicators here that we're talking about. Second one is growth potential. And there's a specific way that we look at growth potential to make a determination as to whether or not this appears to be a business that has the trajectory to grow into the future. The next one we call Switzerland structure. And what that is it's kind of code word within our process or our format, the formulas that we use here. And I'll explain Switzerland's structure later in more detail, but it has to do with independence. You know, how dependent are you on certain factors? And if those factors change, are they likely to tank your business or to slow your business down? The next one is called valuation teeter-totter. And that's really all about cash flow. It has to do with how cash flows into your business and how cash flows out of your business. And it makes a huge difference in terms of value to a buyer as to what that cash inflow, cash outflow looks like. The next one is called hierarchy of recurring revenue. And this is a biggie relative to what we call a soft factor. And that is not just are you profitable, but how do you earn your revenue? And do you have a stream of revenue projected into the future based on contracts or some other sort of a vehicle that says, as I buy this business, I know that I don't have to go out and start building revenue or building clients or reselling clients. I know that there is a stream out to a certain point into the future, and in some instances, infinitely into the future, conceptually infinitely into the future. The next one is called monopoly control. And that is looking at your business from the perspective of how likely are you to keep your clients because your clients are dependent on you. And that is that you have a monopoly. And we're not talking about monopolies like, you know, the water provider in your community or things of that nature, but in the context of your client base and how you interact with that client base, how likely are they to leave and how likely are they to stay, because what you're offering is unique enough and they really can't easily go get it someplace else. Customer satisfaction is a huge one, and that is, are your customers happy? Are they satisfied? Are they likely to leave? And are they likely to stay with you going forward? We'll talk about that in more detail. Then the last one is hub and spoke, and that's all about you as CEO. As CEO, is the business so dependent on you that if a buyer came in to buy this business, they would have to keep you on for a longer than normal amount of time just because the team doesn't know how or doesn't understand the details of running the business as you do, or they don't understand the details of decision making. And a lot of this really has to do with culture, decision making, how decisions are made within the company and things of that nature. So with that as a kind of a high overview, Steve, do you want to say anything before I move on to the next slide where we begin to get into more detail on some of these drivers?
So just real quick, what you're seeing before you is a dashboard, obviously I think very easy to understand. This is a tool we use with our clients. We assess every client we work with using this tool. And it does provide a very nice, easy to understand visual. And what it does is it shows the business owner where their particular score is in relation to their industry as a whole. So, you know, it looks like a simple dashboard, but it gives you a lot of information. It shows you, you know, are you at, below, or above the industry as a whole? And if you are swinging in one end of the spectrum or another, it may say that you've got a real unique strength in some areas, or you may have a specific weakness in other areas. And Marquita's absolutely right that while there are 2 of these 8 measures that are financially oriented, the other 6 are very, very important, and they really do bring value to the organization and will be a big differentiator. Frankly, one of the things that Terry says all the time, which is also so very true, is if you score really low in some of these areas, they might even make your business totally unsellable. So if you have some significant deficiencies in some of these areas, while you might have a business that has been going for some time and is generating good, reliable cash flow supporting you and your family, you may not ever be able to sell that. And we'll talk about some specifics of that as we move forward, because we've certainly seen a lot of those instances, haven't we, Marquita?
No, you bet. You bet. Okay, let's go forward one chart, and here are the first 4. And we'll drill down a little bit and chat about these first 4. And in financial performance, we're looking at a couple things here. The history of producing revenue and profit combined with the professionalism of your record keeping. And that's the thing that's very key in what we're talking about here. in general, if you go to a valuation analyst, they're going to ask you for your financials. And one of the questions you have to ask yourself is, do I have an up-to-date profit and loss statement and balance sheet that brings me forward to today? And you'd be amazed at the number of clients we work with when we say, you know, we'd like to see a copy of your 2017, 18, 19 tax return and year-to-date financials through August of 2020. You'd be amazed at the number of clients who can't give us that like within a week. So that tells you a lot about whether or not that company and that owner has a process in place that really is on top of the financials. What happens when you go into the sell process, the due diligence process with a potential buyer, is there will be some deals happen quickly. I mean, I've seen deals happen within 2 or 3 weeks from the date the offer was written. That's very rare. I had one, I can tell you probably my my worst nightmare. We were almost 18 months from the initial letter of intent to when we actually closed the deal. I mean, there were many times when I said, we'll never close this deal. It took so long. And as a result, because there's financing involved, often we had to go back to the owner and say, we need updated financials. And every time we did, it was difficult. And that had more to do with why it took us so long, because we would be out of cycle, if you will, with the bank, or we were out of cycle with another creditor. It was a complex deal. Obviously, there was a lot of debt involved from the seller side, and we needed to be able to stay on top of profit and settlement of that debt as we move to closing. And we just simply have to push the closing date back. That's an interesting story. But in addition to a nightmare like the one I just described, in a normal deal, you really want to show that you have sound financial processes in place, so that you're updating your QuickBooks, your accountant or your bookkeeper is updating whatever accounting system you have, and that you can, in fact, produce those interim financial reports without having to have someone go in and find transactions and enter the transactions so that we can get an updated report. Steve, any comments you have on that? I know you have stories too.
Oh yeah, I'm telling you, this is so important, and Marquita is absolutely right. I know it's hard to believe if you're on the outside, but probably 9 out of 10 clients that we work with are not able to produce up-to-date, clean financial reports, within a matter of weeks. Normally it takes multiple weeks, and we've seen it take multiple months to do that. And frankly, the financial reports of your business are the face of your business. They're the face of your business to the owners. They're the face of the business to your bankers and lenders. They're the face of the business to your suppliers and other creditors. And when you go to transfer your business, it is the core group of documents that everybody wants to see first. And if you're not keeping those up to date and current, you really should invest the time and effort to figure out where the holdups are and get over those and get over it quickly. We saw, this pandemic was I think the most illuminating experience of all, because those that could produce financial documents very, very quickly were able to get in line very, very quickly. And as we saw when the aid packages first came out, it was the businesses that were prepared that were able to benefit by getting the aid as quickly as possible. The ones that had to have a lot of preparation ended up going to the back of the line. And there were literally thousands of businesses that missed out. And we all read the horror stories in the newspapers and watched it on the evening news of companies that were not able to get the aid that they so much deserved just because they didn't have their records in order.
Great. Thanks, Steve, on that. I want to remind everyone now, too, as we're walking through these value drivers, if you have thoughts, questions, comments, please enter your questions into the Q&A dialogue, and we will address your questions as we move forward through the webinar this afternoon. But now let's move on to the next one, which is growth potential. And let's talk about what we mean by growth potential. And here is an interesting reason why a buyer would be interested in your business and would want to purchase your business. And that is, certainly they look at your current client base and they would consider that on a plateau financial basis, that they could continue to make money as you have been making money or are currently making money, profit, based on what you've done in the past. But most buyers are not simply buying to remain steady state or to buy the business and manage it on a plateau basis from where you are. They're looking to take that growth curve up. So one of the things they do want to look at is, can this business grow and how can it grow? So what we look at in this scenario is, what are your products and services, and what can be done in the context of the products and services you offer to add incremental customers who are interested in that existing product and service base. So the question is there growth potential within the product and service offering that you bring to the table? The second piece of it is looking at your market, and that is your target market. Is it a target geographical market? Is a target industrial market? And what is the opportunity for your business to sell outside of the current market that you're selling in? So let's say you have a business and that all your clients are, let's say, for lack of a better example, Metro St. Louis based, because we're Metro St. Louis. Let's say your clients are all Metro St. Louis based. And I have a buyer who comes in who may be Chicago based. And he may look at this as an opportunity to grow, not only because of the base you have in St. Louis, but that buyer may see an opportunity to take the product set to Kansas City. So the buyer's already in Chicago, they're buying in St. Louis with potential production opportunity, service delivery opportunity is what they're buying, a client base in St. Louis, but an opportunity to take that same production capability to a buyer group in Kansas City and build on that. So this is what we're looking at here in terms of growth potential, and that is this business one that can grow? Are the products and services obsolete? Or are they on the decline? Is there a demand into the future for them? And then secondly, where's the business located now? Where are most of the clients now? And that is a slice and dice by both physical geography and industry geography. And is there opportunity to grow this business outside of the current owner's target client group? Okay, Steve, you want to chat about that a little bit?
Yeah, I think it was a great overview, Marquita. Just in summary, your business can grow one of three ways. You can either get more clients, you can either sell more to the clients that you have, or you can sell to your existing clients at higher prices. And growth potential really helps you to evaluate each of those things in aggregate and figure out what can you do. And we've seen clients that buy companies just because they want the opportunity to add on products and sell more to their existing clients. And they'll pay a premium for companies that have a nice complement to the products that they're currently offering their existing clients. On the other side of that, if you've been selling to the same clients, the same products for many, many years and have not changed your prices, and your gross margin has been slipping year over year, that's a big red flag that buyers will look at and say, wait a minute, there's a real big red flag in front of me from a growth potential standpoint. If I got to go back and try and get what is a now current market price and raise prices on all those existing clients, I may not want to fight that battle, and I might want to go move on to another company that's in that same field.
Okay, great, Steve. So now let's talk about Switzerland structure, which is the third value builder. And this is a kind of a jargon term, if you will, and it references Switzerland simply because Switzerland has always been viewed as a country that is very independent. They typically don't join in alliances with countries around them. They tend to do everything in a very independent way, so to speak. So what this particular driver takes a look at is, how dependent or independent are you relative to three specific areas, one being customers. What is your concentration across your customer base? Are you dependent on any particular client? And if you lost that client, would it tend to have a substantial negative impact on your business? And an example of that, and kind of a measure point, a metric point, is 25%. A red flag is if you have any single client who contributes 25% of your revenue, immediately that is a flag, yeah, or more, definitely, to a buyer. Because what that says is if you lose that one client, you're likely to lose a very substantial component of the revenue, and what created the value in the business in the first place can easily be gone if that client doesn't stick with you as the buyer. And that's always a risk a buyer is taking. Probably one of the biggest risks is how many clients will remain with me as I buy this business. So what is the baseline that I am building on from a revenue perspective, and I intend to build up? And if that baseline changes, specifically if it decreases, and my God, if it decreases by a number 25% or more, that could be devastating to a buyer, and it could actually all but nullify the value of even buying that company in the first place. So customer base and concentration across customer base, with no single customer being more than or I would say more than 25% or more of your total revenue intake. The next component of that is vendors. How do you create your service? How do you deliver your service? How do you gain raw material to manufacture your product? So think about vendors as both suppliers in the context of hard goods if you're a manufacturer, or people if you use people to deliver a service. Then the question becomes, how dependent are you on that vendor pool relative to being able to deliver? And that is, I sell my business and one vendor leaves, can I still deliver that service? I'm considering selling my business and one vendor decides to shut down. And I've got a real story in that scenario. It makes all the difference in the world based on how you have leveraged your position relative to dependence on vendors and other service providers if you offer a service business. And then the last one is employees. And these are people actually employed within your business. How well are your processes and procedures documented? Do you have multiple individuals, employees within your organization who can do a specific function? How clear are your employees relative to policy, procedure, judgment calls, pricing, so that you can depend on those employees as resources that will move with your business when you sell your business? The worst thing that you could be in is a situation where you've got that one employee who is a term. I used to work with some New Yorkers, and they use the term tank person. I don't know if anyone else has ever heard that term before, but the tank person, have you heard it? Yeah,
I have,
the tank person is the one who knows everything, who's got all the information. You can't get anything done unless the tank person shows up in the office. You know, it's that kind of a situation. And think of your own business from that perspective. You know, let's say you're running a service office and you have an office manager who is the clearinghouse for everything that flows in and out of that office. How well have you trained other people in the administrative pool to back up that office manager? Think of your manufacturing facility. How well are you staffed in terms of the specific tasks that are done in your manufacturing facility? Let's say you are in a position where you do rebuild or repair, and you've only got one person in the organization who's certified to repair a certain kind of equipment, and 50% of your client base or your revenue base is tied into that equipment. It's not a value, as much of a value, unless you had spread that over many employees within your organization. Now, the stories can go on and on and on relative to both, all three, employees, vendors, and clients. But with that, I'll turn it to you, Steve, and see if you want to share some stories or add to what I've said.
Yeah, I'll give you 3 quick stories, one for each one. So as it relates to the employees, you're exactly right. We've seen that many times where there is a key employee that holds a key certification, holds a key responsibility in the company, but is basically an employee at will and doesn't have any idea that the company is potentially going to transition to a new owner, and that employee is totally at risk. So, you know, in those situations, it's always in the business owner's best interest to make sure that they're identifying that and doing whatever is necessary to protect that, if you will. If they don't, it's always a concern that we're going to deal with during the diligence period. As it relates to customers, man, it's the biggest deal killer. If you've got high customer concentration, it's the things that makes buyers the most fearful. So most business buyers, when they come into a transition, are really worried that, are the customers going to be sticky, or are they going to have a relationship to the seller? And if you've got high customer concentration, again, that's just a huge red flag. We actually evaluated a company a couple of years ago that was a phenomenal company doing millions of dollars of revenue with making outstanding margins. The owner was doing incredibly well, and we told him his business was completely unsellable because, as it turned out, he had one major client, and who equated to almost 100% of his revenues. And lo and behold, last year he lost that client, and his business basically was shut down involuntarily. So he went from making a huge living in his business, a nice business, and, you know, virtually overnight it was shut down. But on the other side, you know, let me talk about, you know, if you're dependent on a supplier, that can be a real diamond as well. So, you know, if you've got the Budweiser distributorship here in St. Louis, you've got some exclusivity, and you've got a business that's incredibly valuable. And there are many suppliers that, if you've got an exclusive license to a product in an exclusive marketplace, that may really bolster your ability to be able to achieve value from the transfer of your business to a new owner. And there are some of those relationships that can really work in your favor. So, you know, each of these dynamics go both ways. You gotta really spend some time thinking about, where is my business position in this area, and what can I do to move my business to the positive side of the ledger as much as possible.
Okay, good. Let's talk quickly about valuation teeter-totter, and we'll move on. Valuation teeter-totter, again, is another buzzword, but it's all about cash flow. And what we're looking at here is, how does cash flow into the business? How does cash flow out of the business? And a lot of that typically has to do with your contracts with your vendors, and that is, and your clients, and that is, what's your contract with your clients to pay you, and then what is your contract with your vendors to pay them? And some of this is at will. So often there is an awful lot about this cash flow or cash availability, teeter-totter, if you will, the yin and yang of what comes in and what goes out, that you have total control of, and it's not bound by any kind of a contract. So what we're talking about here is, we want to look at accounts receivable days, because I like to think of revenue as the lead component, and then the payables are the outflow as the follow component. But let's say that most of your clients pay you, and this is a very common thing that's happening. If you have a large client base that are typically publicly traded firms, they very typically will negotiate and negotiate until they get you on a 60-day payment agreement.
Or even longer.
Or longer.
Yeah.
And in the past, we would see scenarios where you would define payment due on demand, and then we would have the, you know, plus 30, plus 40, plus 60, where we actually add on a percentage cost, or the carrying cost of money, based on the fact that they're late paying. But many companies are coming, and they're very astute to do this, are coming to the table, and especially towards small businesses who consider doing business with this large publicly traded firm is just a gem in their client list, and will negotiate scenarios where they're not getting paid immediately, but perhaps 60 days, God forbid, 90 days. So you're waiting 90 days for your cash to come in. But on the other hand, with your vendors, if you have not equally negotiated contracts with your vendors where you're expected to pay 60 days or 90 days, where there is a match, you're going to have a fairly substantial line of credit to carry the cost of that financing that you're doing for your client base. So there are two things. One is, do the contracts demand it, or are you allowing it at will? And that is, are you following up with your clients if you don't have a specific contract on their payable responsibility, to call quickly and remind them to pay, to send an email quickly and remind them to pay, and to see that cash flow coming in. And typically the target should be 30 days. There are exceptions and reasons why you would do a longer pay period for certain clients. And again, that's a judgment you make as a client or as a CEO. But at the same time, really think about seeing that cash come in. You've delivered a service. That money is due you. A 30-day wait is a long time, given that you've delivered the service already. On the other hand, and that is, how do you pay your vendors? And there's an interesting thing that happens. Many vendors encourage us. In my business, I probably get emails constantly from my vendors saying, we want you to go on auto pay and we'll make it so easy for you. And they're offering me all these vehicles. You can do a credit card. We'll create this credit card environment to auto pay. We can debit the money directly from your bank account. So what they're saying to me is, we want you to pay as soon as we bill you. So essentially, we're all being, if you want to say, managed and encouraged to pay as quickly as possible. Now, I'm going to share a quick story with you about some of our clients, because we're Midwest. We're in the middle of the Midwest. I know our audience for this webinar is national, but we're the salt of the earth here in the Midwest. I mean, we're right at the intersection of Missouri and Illinois. And our people are people who have a value system that says pay your bills and pay your bills on time, you know. But on the other hand, we have a value system that says, let's be nice to the poor guys who may not be able to pay on time. And that is the kind of an attitude, if you will, that can really get you into trouble with cash flow in your business. And I can tell you a story. I'll kind of be somewhat vague about the company, but it was a salt of the earth Midwest business that had to do with the chain of delivery of food from farm to table. And this particular guy was in the middle of that chain, and he actually, you know, he paid his bills on time. He had everything set up on auto pay, and he paid when it was due. And in some instances before it was due. When he got the bill, he paid his bills. However, on the other end, he had larger publicly traded firms and large privately held firms who had negotiated him into some long-term payment contracts, and they were not paying him on time. And I'll never forget the day. This is a client Terry and I shared. We walked in to have a conversation with him about value of his business and some other issues related. And he says, I can't believe this. My kid who just graduated from college just went and bought a new truck, and I don't have enough money to trade in my old truck and get a new truck. We looked at his P&L. He had $1 million in receivables in his P&L. So yeah, you can't buy a truck, but you're sitting on top of $1 million in receivables. And it really had to do with this valuation teeter-totter. He was paying as quickly as the bills came in, but he was allowing his clients to stretch their payments out to a point where he was always cash short, and he would really have to go into a line of credit to cover the differential. Steve, I know you've got stories too.
Oh my gosh, we could talk about this one all day, but yeah, you hit the nail right on the head. We're just in the middle of the country, and that's how people do things here. They pay the bills as soon as it hits their mailbox, and they're so gracious to give people extended terms, and they get strung out. Well, listen, we got an interesting question. So the question came in and said, I absolutely love this topic. How are these soft features taken into account in valuations? Is it a score basis of, say, of 1 to 10 or some other rationale? So how would you answer that, Marquita?
Okay, here's what I would say. Often in the valuation itself, you may not see it taken into consideration in the valuation. These are the kinds of things that tend to surprise you as you go into due diligence, and the buyer will come back and say, well, we need to discount for this reason. We need to, or perhaps all of a sudden the offer is up a little bit for some reason, and you don't really clearly understand why. Now, some of these, in fact, are taken into account in the valuation. And what I will say is things like growth potential. Oh God, I don't want to get into the process of building the capital rate, and that is essentially the multiple. It's the process whereby a valuator, a certified valuation analyst, will apply a percentage value, basis points, so to speak, to where they see your business opposite the industry. And they will give you a premium or less. And often that's referred to as the capital buildup model. The story of that is, on average, for a Main Street business, we typically see that number being something like a 0.33, which means that it's normally about a 3 multiple for the average of all averages of all industries and all businesses in Main Street. It tends to go a little higher in lower middle market. It tends to go, and the number goes down. It's 0.25, but it's a 4 multiple, so to speak. So you have to think about that as what percentage of 100. It's four times that multiple to get to 100. So it's a 4 multiple, typically on the average of all averages on lower middle market businesses. The interesting thing about that is that's another, I call it soft indicator, and that is how large is your business. You tend to get more value, if you will, if you have a larger revenue number. So let's say I'm in the distribution services industry and my total revenue is 1.8 million. And I'm being valued against the guy down the street whose total revenue is 20 million. He's going to get a better value per dollar than I get. And that one is very definitely looked at. Some of these others, Switzerland structure, client concentration, they're included in that build-up method. And again, I don't want to get out of my lane because I am not a CVA, but I'm close enough to Terry that as I have brought clients to him and we argue about what the business is worth, I've come to understand that some of the context of that. But the fact of the matter is, yes, in some instances, some of these drivers have the capacity to be captured in a typical valuation. So when you walk away with a value from a certified valuation analyst, one of the things you need to ask yourself is, what's unique about my business and what is the selling point of my business using these unusual drivers here that will take my business to another level? To go a step further on the client, I will, or to your question, I will give you a general story of a client I worked with. We work with lower middle market clients. I had a very unusual situation to work with a client whose business ultimately sold more as an upper middle market, upper middle market. The final deal went for about $120 million. It surprised me and it surprised the owner. And I will tell you this, as we started talking about the business, we looked at a multiple around a 4 multiple, thinking that this business that had a base revenue less than 10 million, I will say, I won't give you the exact number, but it was less than 10 million. And we did a calc and we said, okay, this business is probably worth around 35 to $40 million. And we thought that would be an awesome sell price for that business. Okay. Ultimately, I did not represent that client. I coached the client, but I did not represent him on his deal. And good for him that I didn't, because I didn't see the value. But the specific M&A professional that he used was a very astute and knowledgeable professional within that particular industry range. And he came back and said, I think we can do better, but he only doubled my number. They put it out to bid, and the bids were coming back at 15, 16, 17 multiples. And I mean, we were literally, our jaws dropped, and we didn't clearly understand at that point why the multiples were coming back so big. But then with just a little bit of additional research, we saw very clearly what was happening in the industry, what was happening consolidation wise, why certain buyers who happen to be big buyers with big money, private equity firms and publicly traded firms, were coming in and bidding on this business. They were coming in with a big bid because the client had a very specific process and systems base that was useful. And the intent was they were bringing him in as a platform acquisition, and they were going to do more acquisitions and bring them in and use his systems and processes. So I'm telling you that story to say that just because you use the standard model, the numeric model for valuation, some of these soft issues will create phenomenal value if you have the right buyer and you have the right intermediary who understands the dynamic of the market. Steve, anything you want to say or add to that?
You're so right on. I mean, they can really be big multipliers. So in general valuation, certified valuations typically look at financial performance, growth potential. They look at the valuation teeter-totter. They might get into the hierarchy of recurring revenue, but at best they deal well with 4 of these 8 value drivers. But Marquita's so right. It's these other soft things like systems and processes, like the specifics of the Switzerland structure, like the specifics of your customer satisfaction, like the specifics of the monopoly control that you have over a market, that can really be a big multiplier if you're really in control in each of those areas. So to answer the question directly, that's why we use this tool in conjunction with standard valuation methodology, because standard valuation methodology does a really nice deep dive on the financial dynamics of the business, but it's these other factors that can really make a big difference. And if you measure those appropriately, you want to make sure you don't leave money on the table when you're going to convey some value. And you can end up doing that if you're not aware of how valuable these other things can be in the marketplace. So there's no real hard and fast 1 to 10 rules, but it can really work in your favor. And again, it can really work against you if you've got some big negatives in these areas as well.
Great. So let's move forward and let's talk about recurring revenue. We have spent a lot more time on the first 4, so I'm going to more quickly walk through the next. Recurring revenue, what we're talking about here is the concept of the way you price. It's an approach to pricing your product. And that is, do you sell a product, you get all of your cash in that particular transaction, and then you have to sell the product again to get additional cash, or you have to sell another complementary product to get additional cash. What we're talking about in recurring revenue is it possible for you to structure your product, both in terms of the core product and the service delivery around that product, so that you have a stream of revenue related to that product going out into infinity? And I say infinity,
best case infinity, right?
Yeah, best case infinity. Any buyer typically is going to want to cut infinity off in 3 to 5 years, depending on how strong that product has future value. But the concept being is that once you sell it, it's sold, and there will be a stream of revenue related to having sold that product forever. And there are many models for recurring revenue, and I'll just share a couple with you. Probably one of the best ones that most people know and are involved in is printers. You buy the printer, and the printer is $100, and that printer is valued at much, much more than $100. But in order to use that printer, you have an ink subscription, and these typically look like subscriptions. So you're buying ink at a higher price ad infinitum until that printer actually is sent to the graveyard. But the bottom line is the great revenue option there. It's not the initial cash flow of the printer, but it's the long-term cash flow. And any buyer who's coming in to look at your business, if they can see streams of recurring revenue in your business, it's going to lift the value of your business. Others are software. I mean, we all remember when we used to buy our Microsoft suite for, $300, $400, and we only had it for then. You can't even buy a perpetual license on anything. What you buy is a subscription. So Microsoft is hitting your bank account, your credit card, whatever, every single month, and they have that stream of revenue forever ad infinitum from you. That adds value to your company, and that's why you'll find so many companies now are asking you to give us the credit card, and we're going to bill you every month for an X amount. Now, this is not a panacea. And one of the things that we do with clients when we talk about recurring revenue is really understanding on a product by product basis, on a service by service basis, are you better off selling it as a one-time high priced sale, or are you better taking that product and stringing the income over a period of time, an infinite period of time? And it's a real interesting internal model as to when it works and when it doesn't work. So it isn't a scenario that all products and all services should be sold via the concept of one of these recurring revenue models, but by and large, you do have products that fit into this category, and you will up your company's value substantially if you can show a large amount of your revenue as being guaranteed year after year after year, and not something that buyer will have to go out and resell going forward. Steve, thoughts on that?
Beautiful.
Great. Okay, let's go ahead.
No, perfect. Let's move on.
Let's go on. Monopoly control. What we're talking about here is your business truly, or the products and services you offer, really a monopoly? And can your client easily go and get your service elsewhere? So we talk monopoly commodity. Is what you sell such a commodity that the client can leave you today or tomorrow and go down the street and buy it from one of your competitors with easy conversion? One of the things that I always talk about with my clients when I talk monopoly control, and that is your relationship with your banker. The products and services that you have in a bank. How easy is it, and how likely are clients to switch banks because the next bank lowered the price or whatever? It's hard to change banks if you're a business. There is so much interwovenness in the multiple products that we use as businesses that it's really difficult. And I will say to you, for as much as banking appears to be a commodity, a specific bank can in fact be a monopoly in terms of how they structure pricing and how they structure the interwoven relationship of one product to the other. And there I'm talking about your checking accounts, your demand deposit accounts, your debt accounts, and that is mortgages, lines of credit, other loans, and your payment processing account, that is your merchant services account, things of that nature. And you can get so woven in the way you use these products with a bank that you can all but not leave. That's just one example, but I think most people can relate to that example. And you think about your products, it can be a true commodity, but you can structure it to be a monopoly. Steve, any thoughts on that?
Absolutely, and it can happen in any particular industry. So if you look at even something like gasoline, right? There are companies that have created loyalty programs and so forth that customers will drive for. Think of Costco. Costco has created this reputation for lines at their gas pump because Costco is elected to make zero money from their gas. So they typically have the lowest price in town. People recognize that Costco as a brand is a high quality brand. So you will always see lines in front of their station lined up for gas because it's the lowest price in town. And people will drive. My wife in particular will make it a point to drive to Costco to fill up just for that reason.
Yeah.
So, there's no product that is immune from this monopoly control. It's all about putting your thinking cap on and figuring out in your particular industry, what are the key drivers of the relationship with your client that you can make a monopoly around, and that will really insulate you in the marketplace.
Yeah. Let's go on to customer satisfaction. One of the things we do with our clients in this process is we do Net Promoter Score. And I think most of you should be aware of what Net Promoter Score is. It's that single question that we tend to ask and are often asked as clients. Would you refer your friends and neighbors to Marquita Wiley Inc.? You know, what is the likelihood that you will do business again? And then the question, how satisfied were you? The question, how satisfied were you with your experience, and rate on a scale of 1 to 10? You want 9s and 10s. A 9 and a 10 is a promoter. A 1, 2, or 3 is a detractor. And everybody in the middle, it doesn't matter. We don't know if they're going to stay or go. The 9s and 10s are going to stay. The 1s, 2s, and 3s are going to complain. And your score is the percentage of people who gave you 9s and 10s minus the percentage of people who gave you 1s, 2s, and 3s. So these scores tend to come out around 50% or less. World class is about 60%. What's really interesting is some of our small businesses that we run through this process have phenomenally good Net Promoter Scores. And it essentially shows a buyer that you have a very satisfied and happy client base, and it is an indicator that client base is likely to stay even through an acquisition, and it gives that level of comfort that there's less risk in the transition from one owner to another. Anything on that, Steve?
Oh, beautiful. You got it nailed.
Okay, great. And then Hub and Spoke. What this is, it's all about you as CEO. And that is, as CEO, think of the picture of a wheel with you as CEO as the hub, and all processes, procedures, customers, relationships, all that happens within your business as the spokes and outer rim of the wheel. Okay. And the question becomes, are you a hub or not? And here's what's very, very interesting about this is there's certain components of hub and spoke that are counterintuitive, because a more valuable business to a buyer is one where the current owner is not central to the relationships. That is central to every employee, central to every decision, central to the customers, central to the processes and procedures. And what we mean by that is, if we have to make a pricing decision, how's that pricing decision made? Do your people understand the culture, the profitability model, the thought process about this company to a point that your salespeople can make those pricing decisions? They can make pricing exceptions without coming to you. Because if all those decisions are coming back to you as CEO, that's not a good indicator. Same is true on the customer side. Let's say you've got a big customer, and that customer has an issue and they want to talk to someone. They call and they get customer service. Well, no, I don't want to talk to customer service. I want to talk to Joe, the CEO. Okay, that is problematic, because the wheel or the whole process should work. The engine should work. The wheel should turn in a way that clients are comfortable with dealing with problems, good news, bad news, pricing exceptions, shipping exceptions, potential manufacturing exceptions. At the right point in the organization, everything should not have to come back to you as CEO. Okay. I always use the term, and let's say my client's name is Joe. I would say, always think about the WWJD, not what would Jesus do, but what would Joe do? And if every one of your employees can say, I know what Joe would do, I know what Joe would say, and I feel empowered and comfortable to make that decision, to deliver it, and know that Joe's not going to be on my back yelling at me because I made the wrong decision, that is a well-run company. And that makes all the difference in the world, because the buyer coming in may not want to sit in your seat as a participative manager in the company. That buyer is probably looking at this as an economic decision, and they want the team to be able to run that business. Okay, we're getting to top of the hour. So Steve, I don't know if we have additional questions or if you have comments, but I'm going to kind of give it to you to wind us down.
Okay, one quick comment on what you just talked about from the hub and spoke, and I love your WWJD analogy. Think about if if you're Joe and the name on the door is Joe's Service Center, and the customer walks in and the only person they see and deal with is Joe, if Joe leaves, it's very difficult for a buyer to envision them in Joe's position, because now the buyer knows that every customer's got the relationship with Joe. The business is named after Joe, and Joe is the central delivery point of everything that's there. Boy, those are businesses that are really, really difficult to convey. The only way to really convey them is to Joe Jr. Now, Joe Jr. can come in and do well, but anybody that's not Joe Jr. is going to have a rough go of it. So you got to think about your business in that way. Listen, we do this every day. As I said earlier, we do it for every one of our clients. We strongly encourage you, if you're a business owner out there, do this assessment for yourself. We're very happy to provide it to you. We'll provide it to you free of charge. It's a very, very valuable assessment, and it allows you to be able to see where you are and where your business is right now. And it is important because, you know, every business is going to convey, whether you're going to convey it to somebody you know, somebody in your family, or somebody that works for you, or somebody that you know, or somebody that you don't know, through potentially a transfer or a sale process at some point in the future. It's all of these 8 drivers work to form the value nucleus of your company. And we believe it's critical for you as an owner to understand where you are, particularly in this time of the pandemic that we've just gone through. So many people have had so much pressure exerted on them that was outside of their control. And many times they were in situations where their business just wasn't transferable because they may have some significant deficits in one or more of these areas. Don't go to bed wondering about this. Take a few minutes, go to the link on your screen here, tap on that link. There's no credit card required. It's not going to ask you for your firstborn child's name. You can go very simply and plug in your name and information. Everything is 100% confidential. It never goes outside of our system. And you just put in your information and we'll get back to you and send you your score summary. So we strongly encourage you to do it. It's one of the things we require every one of our clients to go through. And again, we're happy to provide the assessment for you. So take a few minutes and do it. It'll give you some things that you're going to want to do to make some changes in your business. It'll probably show you some things that you weren't aware of in your business. And that's good, because it gives you an opportunity as an owner to really improve and begin to build on the value that you've already put into your business. So Marquita, I think you did a marvelous job with the overview. This is what Marquita does most days. So she's intimate with these products and processes. And if you want to engage with Marquita and go deeper, she's available to do that. She just does a wonderful job, as I'm sure you all have seen over the last hour. So we are very appreciative of your time and attention every week on these calls. You have our contact information. If there's anything else we can do to help you, please don't hesitate, but use this tool. It's free, there's no obligation, and it can do nothing but help make you and your business better. So we strongly encourage you to do so. Marquita, any closing words?
For everyone on here, as always, we will provide this information, including the content of this PowerPoint deck via our YouTube channel. So expect to see that within the next 24 hours. So don't worry if you didn't write down the URL here. It will be out on the YouTube channel, and the deck will be out there in our Google Docs. So expect to see that soon. And thank you all for participating. We look forward to seeing you again next week.
Thank you so much, Marquita. You have a wonderful afternoon.
Bye-bye.
Bye-bye.